Let's take a step back and set the scene properly, because what's happening in the silver market right now isn't just another noisy trading day. It's one of those moments where, if you blink, you miss the real story. 24 hours ago, the mood was fear. Today, it's disbelief. And somewhere in between, a very deliberate trap was sprung, just not on the people who thought they were in control. Yesterday's 4% drop wasn't random. It wasn't panic selling by accident. It was a calculated shove lower designed to scare retail traders, trigger stops, and flush out anyone who was over-leveraged and feeling a little too confident on the long side. Price was driven down toward the mid-70s, tapping into that pool of liquidity where weak hands live. The machines did what machines do best: hunt, execute, and move on. If you were watching the chart at that moment, it looked ugly. The kind of ugly that convinces people the trend is broken and it's time to get out before things really fall apart. Fast forward to today, and that entire narrative has been erased with one aggressive vertical move. Silver didn't grind higher. It didn't hesitate. It launched. We're now trading around $80.23s, up more than 6% in a single session. That's not a normal fluctuation in a market like silver. Commodities don't behave like meme stocks. When you see a move of this magnitude, this fast, you're not looking at emotion alone, you're looking at structure. What today revealed is that yesterday's sell-off wasn't the start of a breakdown. It was a failed bear trap. The moment the forced selling ended, the market didn't stabilize and drift sideways like a weak asset would. Instead, it exploded higher. That tells you everything you need to know about what was sitting just beneath the surface. There was a massive wall of limit buy orders waiting patiently below the market. Smart money, industrial demand. Sovereign players who don't chase green candles and don't panic on red ones. They wait. And yesterday, they got exactly what they were waiting for. Once those buy orders were filled, supply vanished, sellers were gone. And when supply disappears in a market that still has demand, price has only one direction to go: up, fast. Now let's talk about that $80 level, because this isn't just another number on a chart. For traders, $80 per ounce is a psychological fortress. It's a level that attracts headlines, algorithms, and egos. Breaking above it matters. And we didn't just poke our head above it, we smashed through it with volume. That's significant. It means anyone who was short silver, betting on lower prices, is now underwater. Losses are mounting, risk managers are tapping shoulders, and buy orders are being forced into the market, not because traders want to buy, but because they have to. That's how a short squeeze starts. One short seller covers, pushing price higher. That move triggers pain for the next short, who also has to cover. And suddenly you get a feedback loop where buying begets more buying. Judging by a 6% day, those dominoes are already tipping over. But silver doesn't move in isolation, and it never has. To understand the bigger picture, you have to look at gold. Gold just crossed another historic milestone, trading around $4,540, up over 1% on the day. Gold is the general of the precious metals complex. When gold makes new ground, the rest of the sector tends to follow. What ain't as important here isn't just that gold is rising, it's just the difference in speed. Gold moves like a tank. Silver moves like a sports car. Gold up 1%, silver up 6%. That's silver beta in action. This is the market waking up to the reality that silver is deeply undervalued relative to gold. At $80, silver isn't expensive. It's sprinting to catch up. The gold to silver ratio has been stretched for a long time, and now it's starting to compress. Not because silver suddenly became fashionable, but because the math is finally being respected. That said, let's keep our feet on the ground. Markets don't move in straight lines, no matter how exciting a vertical green candle looks. A day like this almost guarantees volatility. We could easily see a pullback towards $78, maybe even $76, as short-term traders take profits and late buyers get shaken out. That wouldn't invalidate the move. It would be normal. The key is not letting short-term noise knock you out of a long-term thesis. From a technical perspective, today printed a textbook bullish engulfing pattern. Today's buying completely overwhelmed yesterday's selling. That's a momentum shift, plain and simple. The balance of power has swung from sellers to buyers. The trap that was set yesterday snapped shut today, but it didn't catch the bulls. It caught the shorts. Now, here's where the story gets more interesting and, frankly, more dangerous. The real tension isn't just on the New York chart. It's in the relationship between New York and Shanghai. We've already been talking about the massive premium in the East. So when New York jumps $6 in a day, the obvious question is this: did Shanghai come down to meet us, or are we still racing to catch up to them? That's the arbitrage game, and it matters more than most traders realize. Because while traders are celebrating or panicking, there's another group that doesn't have the luxury of waiting for a pullback: industrial users. For them, today wasn't exciting. It was terrifying. If you were a solar panel manufacturer and you didn't lock in supply yesterday at 74, you woke up to a nightmare at $80. The cost of doing business just jumped, and the metal you need may not even be available. A 6% move for a day trader is a good day. A 6% move for a global manufacturer is a logistical disaster. Imagine you're responsible for sourcing silver for a semiconductor plant in Arizona. You operate on a just-in-time delivery model. You don't hold massive stockpiles because inventory ties up capital and hurts margins. Yesterday, you saw silver dip to $74 and thought, great, things are cooling off. I'll wait a bit and buy cheaper. You tried to time the market. Today, the market punished you. Now the price is $80. Buying 23 orders. You're not buying because you want exposure or because the chart looks bullish. You're buying because if you don't, your assembly line stops. Production halts. Contracts are missed. Costs explode. This is forced demand, and it's very different from investment demand. An investor can choose not to buy. An industrial buyer often can't. That's the part of this move that most charts won't show you. Physical supply chains don't adjust instantly. When price jumps like this, metal doesn't magically appear. Refiners, fabricators, and logistics networks need time. And when they don't have that time, panic sets in quietly, behind closed doors, in procurement departments that never post on social media but move far more metal than any retail trader ever will. So yes, today was dramatic. Yes, it was exciting. But more importantly, it was revealing. It exposed who was guessing, who was patient, and who is now trapped. Silver didn't just move, it sent a message. And the message is that this market is tighter, more strategic, and more unforgiving than most people think. The crime scene wasn't the drop. The crime scene was what came after. There's one group in this market that doesn't get the luxury of patience, and that's the factory floor. A trader can wait. A speculator can step aside. A manufacturing line cannot. When the metal doesn't arrive, the machines don't care about macro narratives or technical patterns. They simply stop. And that reality is exactly what's feeding the pressure we're watching unfold right now. This is where the arbitrage window comes into focus. Yesterday, we highlighted a gap that simply could not exist for long. New York was trading silver around $74, while Shanghai was closer to $86. A $12 spread in a globally traded, physically shipped commodity isn't a curiosity. It's a flashing red warning sign. Metal doesn't teleport. If prices diverge like that, supply flows toward the higher price until the imbalance is corrected. And physics, not opinion, decides how that ends. Look at what happened next. New York didn't gently drift higher. It jumped $6 in a single session. The gap started closing, not because Shanghai collapsed, but because New York surrendered. That distinction matters. The Western paper market didn't assert control. It capitulated. The price discovery mechanism shifted east, and the West was forced to reprice at speed just to slow the outflow of metal. The real price, the one anchored to physical demand, is being set where the metal is actually wanted, not where it's traded in infinite paper form. But there's a second-order effect of this kind of volatility that almost nobody talks about, and it's far more dangerous than a chart spike. It's called a seller strike. When an asset rises 6% in a day, physical sellers don't rush to market. They vanish. If you own silver bars and you wake up to a vertical green candle, your first instinct isn't to sell. It's to wait. Scrap dealers pause. Refiners hesitate. Mines slow deliveries where they can. Everyone assumes tomorrow's price will be higher than today's, so supply dries up at precisely the worst possible moment. That's how you get a liquidity vacuum. Buyers are scrambling to secure metal at $80, while sellers are quietly waiting for $85. The bid-ask spread widens, slippage increases, and price action turns violent. This is what the breakdown of the so-called efficient market hypothesis looks like in real time. In textbooks, higher prices bring more supply. In real squeezes, higher prices scare supply away. It's counterintuitive, uncomfortable, and extremely destabilizing. We've seen this movie before in other asset classes. The higher the price goes, the more desirable the asset becomes. And right now, silver at $80 is behaving less like an industrial input and more like a scarce store of value in a currency stress environment. The move feeds on itself. Demand rises, supply retreats, and volatility becomes the norm rather than the exception. That said, let's not pretend this will be a straight vertical line to the heavens. Parabolic moves almost always come with sharp pullbacks. It would not be surprising at all to see attempts by the paper market to knock the price back down, maybe towards $78, to test whether this breakout actually holds. That's standard procedure, but here's the difference this time. The industrial floor has moved higher. Solar manufacturers are no longer dreaming about $60 silver. That chapter is closed. They're now fighting to secure supply in the 80s, and that reality lifts the entire base of the market. As the floor rises, the ceiling becomes harder to define. And that's when markets start to feel unhinged. But silver isn't moving in a vacuum, and focusing only on industrial demand misses the bigger signal. This 6% move isn't just about solar panels and electronics. It's also about money. More specifically, it's about the bond market quietly losing credibility. Gold trading above $4,500 isn't just impressive, it's historic. Gold doesn't care about quarterly earnings or production bottlenecks. Gold is a monetary barometer. It's the Tier 1 reserve asset held by central banks. When gold breaks to new highs, it's not speculating, it's voting. And right now, that vote is a clear expression of doubt in the stability of the global debt system. A gold price north of $4,500 is the market sending a message to policymakers, particularly the Federal Reserve, that confidence in sovereign debt is eroding. Bond yields, fiscal deficits, and monetary credibility are colliding, and capital is responding the only way it knows how, by moving into tangible assets that don't carry counterparty risk. That's why the silver candle is so aggressive. Silver sits at a unique intersection. It's half industrial metal and half monetary metal. When industrial users panic, silver rises. When the monetary side wakes up, silver doesn't just rise, it accelerates. Right now, both forces are pulling in the same direction. For years, silver was treated like a second-tier commodity, lumped in with base metals, ignored as a monetary asset. Investors forgot what it actually is, but with gold making all-time highs, that amnesia is fading fast. Silver is being rediscovered as what it has always been, the accessible monetary metal, the so-called poor man's gold. It carries the same monetary properties, but at a price point that still allows broad participation. At $80, silver feels expensive compared to last year. Compared to a $4,500 gold coin, it's still a bargain. And that contrast matters. It fuels retail fear of missing out. Retail money doesn't analyze yield curves or sovereign balance sheets. It chases momentum. When people see a plus 6% ticker, they don't ask why. They ask how to get in. That emotional flow of capital is powerful, but it also exposes a structural weakness in the market. For every ounce of physical silver sitting in vaults, there are hundreds of ounces of paper silver traded through futures and derivatives. That imbalance works as long as prices are calm. When price moves violently, the math starts to break down. The banks that sold those paper contracts are now short gamma. As the price rises, their exposure increases nonlinearly. Hedging becomes more expensive. Liquidity thins. Risk desks start to sweat. And when risk managers get uncomfortable, they don't debate philosophy, they force action. This is where things can get unstable very quickly. The derivatives market is like a tightly wound spring. Most days it behaves. On days like this, it creaks. Silver doesn't need to become scarce overnight for this structure to strain. It just needs volatility. And volatility is exactly what a 6% move delivers. Zooming out, this isn't just a story about one metal. It's about a broader shift in how capital is positioning itself. Money is quietly backing away from promises and moving toward things that exist. Bonds represent confidence in future repayment. Metals represent present reality. When that preference changes, markets don't move politely. So yes, silver up 6% is dramatic, but gold above $4,500 is the real headline. Silver is reacting to it, amplifying it, and translating it into something the broader market can feel. This isn't speculation in the traditional sense, it's repricing. And repricing, once it starts, has a habit of overshooting before it settles. The takeaway here isn't to chase candles or panic at pullbacks. It's to recognize what kind of environment we're in. One where physical constraints matter again, one where arbitrage isn't theoretical, and one where the line between industrial necessity and monetary insurance. At this point, what you're watching isn't enthusiasm anymore. It's damage control. The institutions on the wrong side of this move aren't reassessing their thesis. They're bleeding capital. And when that happens in a leveraged derivatives market, there's only one response available to them: buy. Not because they want exposure, not because they suddenly believe in silver, but because the losses are forcing their hand. This is mechanical, not emotional. It's margin math. To stop the bleeding, they have to buy futures contracts to cover positions that are now deeply underwater. That buying pressure isn't discretionary, it's mandatory. And the irony is brutal. They are rebuying from the very speculators who recognized what was happening early and positioned themselves ahead of the squeeze. This is what a derivatives break looks like in real time. When leverage unwinds, prices don't move smoothly. They detach from what people think is reasonable and instead move according to stress. We've seen this before. Nickel in 2022 is the textbook example. Prices went vertical, the London Metal Exchange froze, trades were canceled, and the credibility of the market took a hit that still hasn't fully healed. What's happening in silver isn't there yet, but the early warning signs are flashing. Volatility is expanding. Bid-ask spreads are widening. Liquidity is thinning exactly when demand is accelerating. The paper market is struggling to contain the energy coming from the physical side, and that tension never resolves quietly. Which brings us back to the safe haven question. Because silver doesn't do this on its own. Gold at $4,500 isn't an accident or a coincidence, it's a response. Bond yields, when adjusted for inflation, are unattractive. In real terms, they're destructive. If inflation is running hot and your bond pays less than the inflation rate, you are guaranteed to lose purchasing power by holding it. That's not investing, that's volunteering for erosion. So capital does what it always does in that environment. It leaves. It looks for somewhere it can't be diluted, printed, or restructured away. Gold is the mansion, silver is the guest house, and right now the mansion is crowded. Central banks, sovereign funds, large institutions, they've already taken their seats. So the next wave of capital flows into the guest house. Same neighborhood, smaller price tag, very similar monetary properties. This isn't just about profit anymore. It's about preservation. An ounce of silver at $80 buys roughly the same basket of real goods today as it did yesterday. $80 in cash does not. The currency is melting quietly, the metal isn't. That difference is subtle until it suddenly isn't, and then everyone notices at the same time. Now let's talk about where this goes, because breaking $80 isn't just symbolic, it's structural. Once a market clears a level like this, it enters a different phase. The chart shows very little resistance between here and $100. That doesn't mean we move there in a straight line. It means the market is now in price discovery. Open air, no recent historical reference points to lean on. But with that opportunity comes risk. When markets go vertical, margin clerks get nervous. Exchanges don't like disorderly moves, especially when leverage is involved. Margin requirements can be raised overnight to cool things down. That doesn't change the fundamentals, but it absolutely increases volatility. You have to be prepared for that if you're involved. This is not a smooth elevator ride. It's more like turbulence with a destination. Expect violent swings. $10 daily ranges will start to feel normal. Silver could hit $90, pull back to $82, then rip to $100 faster than anyone expects. These moves aren't random. They're designed to shake people out, to exhaust emotions, to make holders question themselves right before the next leg higher. We've already done the hard work in this investigation. We've dissected the trap. We've examined the supply shock. We've walked through the monetary breakout. Now the only question left is destination. Where does this train actually stop? Let's do the math with today's numbers, because the math hasn't changed. Only the inputs have. In the mania phase of prior bull markets, 1980, 2011, that ratio compressed dramatically, often toward 30 to 1, sometimes even lower, briefly. If we apply a 30 to 1 ratio to today's gold price, $4,500 divided by 30 gives you $150 silver. That's not speculation, that's arithmetic. And we're trading at roughly half of that. What does that tell you? Silver would need to double from here just to reach parity with gold's current performance. And that assumes gold stops rising, which, given the state of sovereign debt and monetary policy, is a heroic assumption at best. So what happens next? We're entering a phase where psychology matters more than precision. Above $80, there's very little historical resistance. This is where fear of missing out takes over. Mainstream media will rediscover silver like it's a brand new invention. CNBC will run segments about the silver rush. Someone you didn't expect, maybe your Uber driver, maybe a relative who hasn't asked you about markets in years, will suddenly bring up silver coins. That retail wave doesn't start the move, but it accelerates it. It's the rocket fuel. The institutions are already positioned. They bought the dip at $74. They're calm. They're patient. And yes, they will absolutely try to shake you out again. That's how this game is played. The key to surviving this phase isn't prediction, it's discipline. Ignore the noise. Focus on the signal. Ask the questions that actually matter. Is the Shanghai premium disappearing? No. Is industrial demand from solar and electronics slowing down? No. Is the Federal Reserve winning the inflation fight? No. As long as those three pillars remain intact, the trend is higher. Volatility doesn't change that. Headlines don't change that. Daily candles don't change that. What we're witnessing is the repricing of a strategic asset. Silver is transitioning right in front of us from being treated as a generic industrial commodity to being recognized again as a monetary reserve asset. And the market is slowly, painfully realizing that there's not enough physical metal to support the mountain of paper claims built on top of it. The derivatives market isn't malfunctioning, it's revealing itself. Decades of leverage suppressed the price. That leverage is now unwinding. And when paper claims exceed physical reality, the price has to rise to ration demand. There is no other mechanism. This is why physical ownership matters. Paper contracts can be settled in cash. In a squeeze, cash settlement isn't a convenience. It's an admission. It means the metal wasn't there. If your goal is protection, you don't want a promise. You want the bar. You want the asset with no counterparty risk. The move to $80 isn't the end of the story. It's confirmation. The trap failed, the squeeze is underway, and the window to acquire silver at double-digit prices is narrowing fast. This isn't hype. It's history unfolding in real time. Blink, and you'll miss it.